I went to a real estate event. It had to have been like 2 or 3 years ago. And at that real estate event was the main speaker continued to talk about this one lady. And she was like the meetup queen. I mean, he brought her up like 4 or 5 times. And I was like, I have to go meet that lady. Unfortunately, I wasn't able to meet her at that event, but we met probably about 6 or 7, 8 months later at another event, and that lady was Mandy, and she's a rock star in the real estate industry. She has over 200 doors in multifamily space, and she's just a person that just loves to pour into people, is looking to grow, is looking to just continue to have impact in life and in business and personally and professionally and financially. And I love being around people like that just want more and they're willing to put in the work to go get more. So Mandy, I want to allow you to tell everybody where you're from.
Yeah, sure. Thank you. What a kind intro, Oliver. Yeah, I love a chance to be around my people, people who are interested in learning and the hustle. Like, who else is up at 8 o'clock on a Saturday because they want to talk real estate investing? You are all my people. So I grew up on a farm in small town Illinois. I actually have a bunch of family outside of DC, so I feel like you are, very much my people. Followed a volleyball scholarship to a little school in Georgia, moved to Chicago right after, ended up always being interested in real estate investing, but instead pursued first. I worked on the floor of the Board of Trade through grad school, and then saw that going away and ended up in medical sales. So just got to a point where my passive income exceeds my day job income. So I'm going to do that day job until...
Let's give you a hand for that. You got to stop.
So I'm going to do that day job until it's not fun anymore, because it is fun and it's a different type of impact. So anyway, that's soup to nuts where I've been in my career.
Cool. Now, how did you grow up? Did mom and dad, did your parents talk about real estate? Was it something that you were, that was ingrained in you as a young person, or?
Well, both my parents were self-employed. My dad is a farmer, which is kind of, in my opinion, a type of real estate investing. Very, 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 very active. And my mom owned a small gift manufacturing company. So I would always kind of dig in and help. Her whole sales force was me. So I would fly to Javits Center when I was 17 years old, and I was her sales force at Toy Fair, So business has always kind of been a thing that's interesting to me, and seeing that, helping someone fix their problem can in turn make you a lot of money.
Wow. Yeah. That's really powerful. So when you were saying that, how old were you when you started going to these trade fairs with your mom?
16, 17.
Okay. All right. So your parents had a business mindset.
Yeah.
They knew that you kind of have to plant some seeds before you start reaping, right?
Mm-hmm.
Cool.
Well, and as a matter of fact, I got so into this when I was 13 years old that I sewed scrunchies. And so every single cheerleading squad or volleyball team within a 20-mile radius had a scrunchie from Mandy one summer.
That's awesome. So how did you get into real estate? What made you jump? If your parents were in the farming industry, your mom was in business, how did you get into real estate?
The thing that really piqued my interest was in undergrad down in Georgia. I was at a party at a friend's house, and she was talking about how her dad bought the house that she was living in, and she rented all the rooms to our friends. And I'm like, oh my God, and you get to keep all that money? That is the best idea I have ever heard in my whole life. So that was the seed that planted that kind of never went away when I was 19 years old. And then, moving to Chicago, I took everybody's advice that you need to own your own place first. And the places that I wanted to live in Chicago, entry level $400,000 condo, so it took a while to save that stuff up, and ended up doing my first transaction for express purpose of investing in 2016. So a lot of analysis paralysis, a lot of learning without action for a lot of years before I actually got in.
Okay. Okay. So now you have invested in over, 200 doors. What was that like? How did you get into investing in multifamily real estate from going from analysis to paralysis?
Yeah. So it just so happened that first transaction that I did in 2016, it was a fourplex by a school up here. It was I wanted it in my backyard. So 2 hours from Chicagoland where I was living. And it just so happened it was a fourplex that I was going to be renting out to students. And I was scared to death of this like tiny little fourplex, and happened to have a conversation with someone who was a super, seasoned multifamily investor. And, he said, oh yeah, I would do that 6 times today and 7 times on Sunday if you'd let me. So that kind of gave me the, belief that, oh my gosh, I do know what I'm looking at. This is something worth doing. And then I took that down in 2016 and, no looking back.
That's awesome. So why were you scared? Why were you scared when you first, like when you were going to buy that 4-unit?
This is something, so I started this Aspiring Women Achieving More. Much of that is dedicated to helping women figure out, how to find power in their own lives. But for me, like I didn't feel like I could possibly know enough. And a lot of, the idea of imposter syndrome that a lot of people have, and I think many women have even more, I'd say, arguably. How could I possibly, who do I think I am to be able to be a real estate investor, So it was mostly that, and the chance to hear from someone who I thought, oh my gosh, this is someone who really knows what they're doing, says that I should be doing this. That gave me the courage to make the jump.
Got it. And then can you provide a little bit more context on the imposter syndrome? Because I've definitely had that for a while too, when I'm trying, like even with starting the meetup, like if I didn't hear about you and you being the meetup queen, like I just didn't think that was like something that I could do, but like you do it, you inspired me to do it, Well, yeah. Can you kind of walk through like what that imposter syndrome looked like for you?
Sure. First of all, it sounds crazy to me to hear that you didn't think you could do this. Because end of the day, it's just making friends, and I think that in anything that you learn a whole heck of a lot about, you have this kind of curse of knowing, right? Like you don't realize that fully understanding how multifamily assets are valued is something that is going to be really interesting to someone who's trying to learn it. So the imposter syndrome stuff for me, I've learned, and actually, so I have my little vision board guy up here. One of the quotes that continually I come back to is that avoidance doesn't extinguish fear, action does. So when I feel like I don't belong, but I know that I know enough to hold my own, but I don't feel like I can take that action because of some fear thing. Because imposter syndrome really, in my opinion, is just some form of fear. If I just go do it, I realized like, oh my gosh, I didn't die. You guys, like everything's fine. Like I made some friends, and sure, like I ended up with stuff like everywhere, but like I didn't die.
Yeah. No, I can totally agree with you on that. Like, so like what you said in the very beginning, you're like we make, and I'm definitely a victim of this. I make it so much more difficult. The equation is X squared plus Z multiplied by T. Instead, it's just like, you're just making friends. You're just building a relationship.
Mm-hmm.
Really that simple, right?
So actually, I had a chance to talk on this same subject shortly ago. And the seminar that Oliver and I met at, they had us climb a 50-foot telephone pole. And then you figure out how to, my palms are sweating every time I talk about it. It's bananas. And then you figure out how to stand on top of it. And then you jump off and try to grab a trapeze bar. The greatest life lesson, I'm not great at heights. So this was a real life lesson thing for me. So that I'm scared to death, right? I don't know what to do next. Right? The life lesson there is if you're scared and you don't know what to do, just take the next right step and it'll all figure itself out.
Right. I love that. Yeah, that was scary, that jump. the transition from climbing up the pole, going from the climbing to the actually standing on the pole, that was the hardest for me.
Well, I had thought that part through. What I hadn't thought through was the jumping off portion. Funny.
But you know what? The part that I saw people get the most pleasure out of was when they actually got on top of that pole and they sat there and just took it all in. You know, sometimes in life we get going so fast that we just literally jump from one thing to the next thing to the next thing, instead of being there in the moment and taking it all in and looking around and seeing the beautiful surroundings, you know?
That's where the juice of life is, you know. Like I feel like if we're all hustlers, right? To be here right now makes you a hustler. Like we play this whack-a-mole with life, and if you continually just speed your way through it, like you said, you don't get to see the beauty.
Right. So can you dive into and kind of break down like one of like your 200 units? Like what does that look like?
Sure. Yeah. So started with a 4-plex. Then I did a 6-plex, and then, you know, on to an 8, and ended up in a syndication because I realized that I don't love the politics or the taxes or, gosh, the rent to value ratios in Chicagoland. So I, you know, suffer from probably the same thing DC area investors suffer from, that I need to kind of look outside of my market. So I went in on a syndication in San Antonio, Texas, 130 units. The business plan was fantastic. Knew some of the general partners and went in on that. And we went full cycle in 22 months. And actually in those 22 months made 50% on our money. So that was super cool. And then from there, realized that, okay, what are these markets that are close enough to Chicago that they can kind of be my backyard, and settled on Kansas City and Indianapolis. Ended up going in with 2 partners on a 53 unit pretty recently in Indianapolis. So that is where we are working to grow a footprint, because in terms of population growth and GDP growth, it has the metrics that we think is going to be a sustainable rental market for a significant amount of time.
Right. That's awesome. I totally respect your courage moving forward and into those transactions, because, you know, like we were talking before, that analysis paralysis is a real thing. So like being able to see the deal, understand enough about real estate that like these are the deals that I want to be in, and then go forward and pursuing it.
I'll say one more thing on that too. When I was doing the 4s and the 6s, and, you know, it was just me, and I was alone in this silo, right? And there wasn't, you know, another opinion to bounce stuff off of, to realize like, oh no, we've thought this through, or we haven't thought this through. It's a mix of GP and LP. For Perry asking right down there.
Yep.
So what I'll say though is, when I found a partner, I have a business partner now who we're looking to grow that footprint in Indianapolis. You know, his strong suits are not my strong suits. So the opportunity to bounce ideas off of this guy who's brilliant in a different way that I understand things gives me so much more comfort, and is why we're growing much more quickly than I did when I was all on my own.
Right. 100% on that. You know, actually the seminar that we met at, right, the person always talks about, I don't ever want to be in a situation where there's one person working on 10 problems. It's always 10 people working on one problem. And anytime you have 10 people working on one problem, the solutions come so much easier. You know, the figuring out the issue that's preventing you from moving forward, or if there's a roadblock, becomes so much easier than when you're all by yourself and you have 10 problems and you can only put 10% of energy into each one of those problems. Problems just continue to grow and get bigger and bigger. So I found it fascinating to listen to you when you were telling me about this acquisition, this recent acquisition, the 50+ unit property. Can you walk us through your thought process when you bought that? Because a lot of the properties that I've been looking at have been, there's 4 classes of real estate. There's your A class, which is going to be your brand new shiny buildings. There's your B class, which is going to be your older buildings, but just right under the brand new buildings. They're not terribly old, but they're like 80s, 90s build, right? And then you got your C class, which is going to be your older buildings from that, like your 70s and 60s. And then the tenant profile may be a little bit more like blue collar, so workforce housing basically. So the property that you bought, can you walk us through that?
Sure.
Like that perspective and.
Yeah, I think I know what you're getting at. And it was something I was kind of proud of, like how clever our little team was on it. So in terms of, we bought this thing mid-pandemic, you guys. If you want to talk about, sweaty palms, homegirl had them. So anyway, so one thing we noticed is the way that I underwrite in order to get through this analysis paralysis stuff. Like I have this kind of Goldilocks mentality that I want to, I'm going to run my numbers like conservatively that I would talk with my equity partners about. And then I also want to run them best case scenario where everything goes my way. But I want to really get comfortable with the world blew up. It's the worst case scenario. So our worst case scenario was we could pay all our bills at a 42% economic vacancy. So in the midst of this pandemic situation, I really listened to a bunch of economists who were talking about job loss and where that was happening. And if you think that all the way through, the people who are losing their jobs are like, manicurists or bartenders or people who have jobs that don't require a college education, the computer programmers and the nurse, well, in most cases nurses, but like sales reps, like we all still kept our jobs. We're just doing them in a different way. So what I did was, we need to figure out what our tenants' jobs are. How do we do that? So we went to the previous property manager and we got the applications that each tenant had filled out. And on that, you have to put who your employer is, right? So I had this whole little stack of stuff, right? And I, said, all right, college educated, not college educated, and kind of made these piles of who has a job that's concerning for us. And in that survey, we found that 20% of our tenants had jobs that we were concerned about, but we had this break even of 42% economic vacancy. So our team felt a high level of comfort to move forward because we kind of knew we buffered our worst case scenario.
Got it. And then from like a return perspective, how did you value the deal? Because, I like, even with like the way you structured it with your lender, how did you work through those details?
So I feel like right now in our current climate, I love a JV setup. More than a syndication, because if you're structuring a syndication, those business plans, investors are really conditioned to want a 3 to a 7 year exit. So you're really kind of locked into this one business plan, one choice. And I feel like JV means joint venture, which means everyone is active instead of having passive investors that don't have decision-making capability. So in a joint venture, everyone is active making these decisions and you can kind of be a lot more nimble rather than you made these promises and now you have to deliver. Right. So
one more thing to add to that, joint ventures, like how many people are in your joint venture?
3 of us.
Okay. So they're typically usually smaller groups of people because, to have all of those people be active, you don't want to have, 50 to 100 people. It needs to be a smaller group.
I have conversations pretty frequently with a girlfriend who has a JV of 11 people, and that is a cluster, you guys. That thing about cooking on Thanksgiving, if you have friggin' 11 people poking their way, 3, okay, we can figure that, but 11, what? Okay, so the interesting thing about the structure of this deal and why I like it for right now is even in looking for this deal, so many people in multifamily, if you go to these boot camps and gurus and whatever, everybody talks, let's look for a super high value add. And that is awesome. That makes you a huge pop of cash right away if you can juice NOI and squeeze some value out of it. However, everybody's looking for that 100 unit plus high value add in a high growth area. There are a lot of eyes on that. So my team, what we did is we looked at, all right, this is what makes sense to us. What can we give up and still achieve the goals that we want? So we're looking in a place that not everybody is looking. So what we chose to look for was, instead of a high value add, what was most important to us was cash flow. So we looked for a super high cash on cash return rather than internal rate of return. What internal rate of return measures is basically the overall return of the investment, rather than cash on cash is just as we go along, how much money is my money making? So what we did is we bought a stabilized asset rather than rather than a value add asset. So meaning we don't have to pump a lot of money in to just get from day one the cash flow that we want. So we put a super long-term loan on this with okay guys, get this. So it's a Fannie Mae product, 30-year amortization. So Fannie Mae means non-recourse, meaning if it hits the fan, they don't come after any other assets than just the one that we're talking about. And 15-year term, that's super long in this world. And 8 years of that 15, you guys, is interest only. So we are really squeezing.
You said a couple of different terms. I want to make sure
I know, I'm sorry.
I
get so excited.
You said amortization. So amortization is 30 years. Can you explain that real quick?
Sure. So if you have a loan on your home, it's basically you owe this much money and we're going to divide it up into slices to how many payments, how much money you're going to owe us every single month. The slices is the amortization.
Got it.
Term is how long that they promise to give you that loan. So 15 years is how long they promise to give us that loan. Of that 15-year term, 8 years of it is we're not paying towards the principal. So we're only paying the interest payments, which means we, get a lot more cash flow.
Right. So that paying interest only, instead of getting principal pay down, so it's basically going to be equity that's kind of locked into the property that you can't get access to. You're now getting that equity right away. She's going to be able to have that for 8 years, right?
Mm-hmm. And it's assumable, which means somebody asked about the rate. It was a 3.68% rate, and we got 75% loan to value. Yeah, so it was a killer loan, you guys. And that's what you can get right now. We're down in the 2s to some of these Fannie products if you get a big enough loan. So.
Yeah, it's awesome. And then you said the term assumable. So this is all for.
Oh, sorry.
I'll summarize it at the very end, but so the assumable, right?
What assumable means is, let's say Brian decides he wants to buy this complex that I've got in 5 years' time. Well, I locked in the rate at 3.68%. Let's pretend this 5 years in the future, we're at a 4.5% rate, right? Well, Brian can then, if he checks all the boxes for Fannie Mae, is able to take on the loan that I used to have. So he assumes that loan, and that becomes particularly awesome if you lock in a super low rate like we did.
Right. So now what Mandy's basically saying is, like, if she sells this loan in 5 years, when interest rates go up, someone will be able to take over her existing loan that is at a very low interest rate. So it provides benefits to investors, and there's a bunch of different exit options now, right?
Yes. Well, that's my reason for going down 12 rabbit holes. I'm sorry for that. Was just to basically say that given this uncertain climate, what gives me a ton of comfort is I have a ton of options.
Okay, cool. Can you walk us through the options that you do have, and like what they're like, what you guys are? You have option 1, 2, and 3, or if you have more.
Yeah, sure. So there's primarily, I'll call it 3. So the first one, it's a 15-year term. So that means we could just keep this asset and let it cash flow for 15 years. And then in 15 years, decide if we want to refinance or if we want to sell the asset. So that's super long-term, number 1. Number 2, we could ride this out for, actually there's, I'll call it 2 primary and then a bunch of different versions of those 2. Okay. So we have 7 years of this 15-year term where that loan is able to be assumed, taken over by someone else. So basically we get a chance in these 7 years to be able to sell should interest rates make that attractive, or should cap rates compress even further. I don't know how that's possible. but we would be able to sell for a much higher price at that point too. So basically we have, you know, a short to middle term exit. If we do that, we have this assumable loan option, which makes that attractive. Or we have a super long-term exit plan, at which time we write out the cash flow. And that's also super attractive for our goals.
Okay. Awesome. Awesome. And then there was a question that came in about, did Fannie Mae have net worth or liquidity requirements?
Yep. So you'll hear agency debt. And what that means is Fannie Mae and Freddie Mac are governmental agencies, and they require that you have a net worth equal to or greater than the amount of the loan. And that can be of your team. So let's say we're taking down a $2 million loan, but my net worth is only $1 million, and Perry's net worth is also $1 million. So Perry and I can come together as a team and have the net worth of $2 million required to take down that property. In terms of liquidity, that is a super moving target. So usually it's like 6-ish months of liquidity to pay your principal and interest towards your loan. But right now in the COVID world, they actually collect that and set it aside in escrow. That is something that is a COVID world situation right now and is a complete moving target. Our team had to set aside 12 months of debt service that we'll be able to get back should we meet debt coverage ratio, some like hoops we have to jump through. If we meet those within 3 months, we can get that money back. And because this is a super safety asset for us, we wanted that rainy day fund anyway. So it was helpful.
Great. And debt service is basically your mortgage payment for 12 months and put into a bank account at that bank, right? And they're going to basically keep it as reserves until a year has passed, and then they would give you back that money if you didn't need it during that time, right?
Yep. They make you jump through some hoops, but it's still your money. So you still get it back.
Cool. So how long had you been looking for that property for?
You know, I was looking to go bigger for some like significant amount of time. And I'll tell you another thing that I think I tell newer investors is I was looking in Kansas City and Indianapolis, and I would go, Indianapolis, oh no, Kansas City, oh no, Indianapolis. I had FOMO. And because like, it doesn't sound like a lot to be looking in 2 markets, right? But because I couldn't get super granular on this block is where growth is going to happen. And that block is scary and I don't want to buy there because I didn't really have that intimate knowledge of any one market because I was spread too thin. I think I lost at least like a year, maybe 2 of progress. So I think the long answer is I looked 2 years for it. The short answer is the minute I started focusing in a kind of laser-like way, like 4 months.
Wow. So what was during that time when you were going fear of missing out? Like what were you fearing missing out on?
Oh, it's hilarious. Oh, well, these people are doing that and she's so smart. And oh my gosh, these guys, and I could do 2% better on my money over here. And you know, it's just straight up FOMO. Like it's just like the folks that I've been coaching, I've been telling them like, listen, you might do like 1% better, but who cares? Like you're going to be so far ahead if you just pick what you pick and just decide and go all in on figuring that out. The more granular you can get, that's when you figure out where deals are.
It's awesome. Well, we're happy that you bought that deal. That's awesome.
Well, thanks. It's pretty cool.
What are you looking at next? Like, where are you headed next? Are you looking to basically use the same blueprint on the next deal, this frame of thinking on the next?
Yeah. So through the meetup that I run, so my business partner is a guy who I started partnering with in terms of running it because like you're probably, you know, you're again operating in a silo and it's so much more fun when you get a chance to bounce ideas off of people. So my business partner is also my co-host of my meetup, and we have a primary equity partner who has a large chunk of capital that he wants to place, and he likes this Indianapolis market. So we're going to continue to grow this footprint on our joint venture structure with the 3 of us. Actually, next week, we're headed down to look at a 54 unit. So it's very, like the blueprint is the same. We're gonna try to rinse and repeat because we're looking at assets that not everybody is looking at, these in-place stabilized assets rather than value add. And oh, by the way, if you close on something in any given market, you are automatically the pretty girl at the dance. Everybody wants to show you all of the things. So we're getting a chance to see things early on, and we're really working to capitalize that because we have the money to place and we know the formula, how it works.
That's awesome. That's awesome. So actually, we just got a message in the chat saying, how are you finding your deals? So you also use the term, you're the pretty girl at the dance. So
yeah. So I'll tell you, the way that I look at it, my business partner, he is a commercial broker out of Chicago. So in terms of the thrill of the chase of finding a deal, that is his jam, right? So the way that we're looking at it is, you know, yes, we could go with postcards to mom and pop sellers. That is something that works for a lot of people. We know it, but we have chosen to like look for an asset that not everybody's looking at and let the brokers do what the brokers do, because they're the hunters. You know, they eat what they kill. And if we tell them what we're looking for, they can help us meet our needs. So we're really nurturing broker relationships in a deep way. And it's particularly cool because that's what my business partner does, just in another market.
Very cool. Very cool. And then there was another question that came in that said, has it been difficult to find off-market in commercial multifamily? I just want to add one little caveat to that. So every deal in multifamily is off-market. They're always going to use that term because as a person selling something, it gives you like this exclusivity, like it's your exclusive, right? So like every deal is going to be considered kind of off-market. It's like, but the real off-market deals are the deals that are not marketed at all and only like 1 or 2 or 3, maybe 4 people are looking at, right? Mm-hmm. But if you can kind of walk through that, like, has it been difficult to find stuff off-market?
You know, saying off-market is like saying VIP. Like I mean, sure, it matters, but I mean, it doesn't matter, you know. The thing that I'm learning, that I'm kind of letting sit in my head is, yes, if you're the first guy to get to look at something, theoretically, you're going to get the first, you know, bite of something that's very, very good, right? Like that makes a ton of sense. But if something is even on market and you have done a really good job defining what your criteria are, what you need to get out of a deal, doesn't matter if it's on market or off market. What matters is what yardstick have you decided that you need to measure a deal by.
Yeah, that's really, so that you basically just said you have a buy box, and if something doesn't land inside your buy box, you're not buying it.
Right.
What does your buy box look like?
So first and foremost, in a market that is going to support renters for the long term. And
that look like?
So I need to see significant GDP growth, which means that people's wages are rising over time. I need to see that population has grown over the course of the last 5 years. I need to see that there is diverse employment, that there's more than one industry that supports these jobs. Because if one industry goes bust, like, you know, Houston and oil back in the day, that, you know, you live or die by oil in Houston. So that is first and foremost. The way I look at that is the river's current, right? So if I'm gonna be on a boat, I want to be on a current that is going in the way that's going to help me get to my goals. That is what the GDP and population growth does. So that's first and foremost. Secondly, because of where we're at with jobs and this, you know, transfer of wealth that is just bound to happen given, you know, what we see in the world right now, pandemic or otherwise, I want to be looking for like a B class asset. I don't want an A because those get really hurt on, you know, economic downturns. I don't really want a C. I definitely don't want a D because homegirl ain't going to the hood. And C, I don't really want, because those are the tenants of C class assets are really those people who have those jobs that don't require a college education. The ones that we kind of look to make sure we could deal with, you know, because just in case they lose their jobs. B class assets really are what we're looking for right now. I also want something that's not city center, that's close enough to the city. Because actually I have a friend in a Sunday morning mastermind that is a former Fed economist and Wall Street banker. And he made a great point that if there's, to live in a skyrise in this world of pandemic, people are worried about sneezes, so let's have, I would rather have a little bit of green space. Okay, so basically it's good market, it's B-class asset, and I want to be able to put really good long-term debt on it. So I have those options in terms of exit moving forward.
Okay, cool. No, but that's like the frame that you need to have when you're looking for deals, because if you don't have any parameters, you're never going to buy, because you're going to have that fear of missing out. You're going to be over here and over there. You got to have parameters. And if something lands in that buy box, then you buy it. And if something doesn't land in that buy box, then you don't buy it and you move on. Keep staying focused on what you want, right?
It's just like shopping for anything. Like, I mean, if you go, I'm just going to go shopping. You're never like, you're not going to know what you're looking for. But if you're like, I need size 6 black pants from Banana Republic, you're going to go get them,
Mm-hmm. Right. Got it. Totally agree. Totally agree.
Lady one.
So cool. So we did get a couple questions that came in. So we have, do you buy based off of NOI and cap rate? So yeah, I'm gonna let you answer that.
So in terms of cap rate, I think that is one of the most misleading measures in all of commercial real estate. A cap rate just is. So what a cap rate to me is, sure, I would prefer to buy at an 8 cap versus a 5 cap, but what that ends up measuring is what were people willing to pay for any given net operating income. So I don't look at cap as a direct measure. Actually, so this book called Hands Off Investor, it's a Bigger Pockets book, had one of the very best explanations of cap rate that I've ever read. So definitely look into that. But what is most interesting to my team, I feel like in anything, you've got this pyramid of decision making. Like, what is the thing that matters most to you? And, if what matters most to you is internal rate of return or cap rate or cash flow or cash on cash, whatever it is, whatever the most important thing is, you're going to do a different deal based off of what that thing that's most important is. And for our team, cash on cash return is the very most important measure. We want to see double. Why? Because we're very cash flow heavy. What we're looking for is wealth preservation, to have our, cash into an asset that is, it's a hard asset that we're going to be able to continue to grow. And we want kind of the annuity. We want the, rather than put our money into something and get paid once, like flipping a house or working a day job, we basically bought into this building that's going to pay us forever. We've developed this flow of forever money. So that's what cash on cash means to me.
So that basically means that you're going to have cash coming in when you're in Italy traveling with your son, right?
Mm-hmm.
Means that you're going to have cash coming in when you're visiting your parents and you're not working, right? So
exactly.
That's why that's extremely important. That's one of the principles that I love most about you, is that you're so focused on making sure your investments are receiving cash so that you can build this future for yourself, right?
Well, thanks. Yeah. I think that, if you're going to earn, the people that I coach, I tell them, if you're going to go try to earn one-time money, like by doing a flip, and frankly, even a syndication, a high value add syndication, you get one big pop of money in 3 or 7 years. That's good, but one-time money only pays you once. Go after that forever money and develop those forever money streams. And in some time, it's going to be, life-changing. So what I want is that cash on cash return. And if we want to see specifically double-digit cash on cash return by year 2 for an in-place asset. So this 53 penciled out at roughly 9-ish% first year. And then without really growing, with very conservative assumptions, we get to 10% by year 2.
So Mandy, let's walk through that real quick. So you said year 3, you want to have double-digit cash on cash return.
Mm-hmm.
So let's just use a quick example. So if you had $1 million of equity in that property, 10% cash on cash return would be $100,000 return for that first year, right?
Yep.
10%, right?
Mm-hmm.
Okay. So, so by year 3, you want to have double-digit cash on cash return.
Mm-hmm.
I mean, without the interest only, or with the interest?
It is with interest only.
Okay.
So, the thing that matters to us is that annuity. And the way, I used to be super nervous about this idea of interest only because, like, Mandy 10 years ago was very Dave Ramsey, Susie Orman disciple, so interest only made me nervous. But the way that I'm looking at it now is, we talked about the ability to assume this loan. Let's fast forward. I hope I don't mess up this concept for you guys because it's kind of in the weeds, but it's interesting that 5 years from now, remember, Perry's going to be buying this thing for me in 5 years, he's going to take over the loan that I have on the asset. Had I been paying down the principal, that loan amount is going to be lower than had I not paid it down. And hopefully Perry's paying more for this asset than I paid for the asset. So the larger the chunk of debt I can hand over to Perry, the better for him, because he's going to have to go get another loan to make up for the balance of what he's going to owe me for the new purchase price. So it's kind of a good thing in ways to have this larger loan balance available to the future buyers.
Right. Because it's a big league concept, but.
So, but I know we've got varying degrees of investors on here, but it's why I'm comfortable with it and interested in it now.
Yeah, I like that. I can follow that. So just I'll kind of try to unwrap that a little bit. So you're saying that when you bought it at, what was the purchase price that you bought it at?
4.15.
So 4.15. So you're saying at a future date, if you sell this at like 5 million, 6 million, right? They're going to assume your debt. So your debt was based off of 75% for loan value on 4 million. So when they bring that new loan to that $6 million purchase, now you're going to have to bring more equity to the table, basically.
Yes.
So you really want that loan to be as high as possible, because the equity that you're going to have to bring, you don't want to have to bring too much equity to the table, or you're going to water down your returns.
Yes, that was really well put.
Cool. All right, cool. So we did have we had a couple more questions come in. So the way the question was phrased was, how do you justify paying for more for a property? So the way I want to ask you that question is, do you ever overpay for properties?
No, you never overpay, but your willingness to pay a little more, because there's brain damage associated with value adds. There is. So the way that I've been looking at this in terms of when I run numbers is, if I'm looking for a value add property, in order to get a deal done now, you have to basically pay for some of the upside. Well, why wouldn't you pay for the upside, meaning the chance to do all this work and then hopefully get the return on investment. Well, why don't I pay full price, kind of, and just get that from day one? So I don't know that totally answers it. I don't overpay. I don't. But what I inform my buying decisions on is that, what's my cash on cash? What is that ultimate goal that I have to achieve for my investing?
Right. So you buy brand new assets, and the way you justify that is by being able to get a cash on cash return on that brand new asset, and then structuring your loan where it's interest only for 8 years, so that all of that additional money that you would be paying to principal falls down to you immediately. So you get your 10% cash on cash or return from day one, basically.
Exactly. Yep.
Right. Cool. Do you 1031 at all?
So I had plans to on this condo I've been trying to sell in Chicago that won't friggin' sell. However, when you get into, so if we were to 1031 out of this 3-person joint venture, all 3 of us would have to agree to do that, and we would move those funds to a new deal that all of us would own. It gets a little hairy there's multiple people involved. And if you're going to 1031 into a syndication, there's a lot of fancy footwork that you'll have to do, and talk to an expert. I have a friend who's a complete expert that if you have questions about a 1031 that you're trying to do, she is a rock star. Shoot me an email and I'll introduce you. Okay,
cool. Do you want to actually, when you get a chance, can you put your email in the chat? I'll ask you this next question. So Harold asked, what is the range of your typical preferred cash on cash return? And I want you to caveat this a little bit. So I want you to say your cash on cash return without the interest only, right? Because that juices your cash on cash return. So like,
it does.
Okay.
But we likely would not have done this deal had we not had the interest only.
Okay. So what would the cash on cash return been on this deal without interest only?
So I'll be honest, we only ran the numbers based off of the loan estimates that we got from our loan guy. So, you know, I didn't run numbers on something I wouldn't do, because I likely would not have done, you know, by year 9, when our interest only runs out, we are still well over 10% cash on cash. We're at probably, I think, 11 and a half by then, even with the drop, because we're paying principal. You know, we just structure the deal in a way that gets us to that end that we want. We would not have done this deal if we didn't have IO.
Cool. So basically your range is like by year 3, you want to have a double-digit cash on cash return.
Ideally, I mean, ideally year 1, but it's acceptable if it's by year 2 or 3.
Got it. Does that answer your question, Harold?
Yes, thanks.
All right, cool. So there was one more question, and I want to definitely ask you one more too. So Jacob asked, do you typically use a mortgage broker, or do you have an already established relationship with a bank?
So the loans that make the most sense. So yes, I do have relationships with local banks, and I'm working to establish more relationships with local banks in the area that we're investing in Indianapolis, because stuff like rehab loans, you can't necessarily get right now through agency debt, the Fannie Mae and Freddie Mac stuff. You have to go to a different type of broker for these Fannie Mae and Freddie Mac type loans. So we have a relationship there because they work directly with these governmental agencies to be able to help us get those. So it's both.
Okay, cool. So Mandy, I want to ask you, what was the worst transaction you ever had?
So huge life lessons in this. So I actually was asked to be part of a very large deal in Chicago, even though I don't like Chicago. Number one, trust your gut. Like the minute that you want to trust your gut, trust your gut. But in terms of trusting my gut, I said, I am not going to do this huge transaction with you if we've never done anything before. So let's do something small. And this investor had a huge portfolio of single family. And I, said, all right, let's do something single family. I did all of my due diligence on these properties, made sure we had all of the paperwork that I could think of that we needed. And long story short, ended up getting fleeced for a boatload of cash. He took it and ran, basically. And I'm not the first person he did this to. So what I'll tell you, my major lesson there is, especially if you're friends with someone before doing a deal with them, do a background check and do a lot of digging into that person, because even if you've asked hard questions, you feel like you've had hard conversations, if you haven't done the full scope of due diligence because you go to church with him like I did this guy, you don't know until you've done that digging. So trust but verify.
Yeah, trust but verify.
Mm-hmm.
Trust but verify, 100%. Totally agree with that. So Perry asked, do you have a different cash on cash goal after IO period?
It goes up. I mean, over time, if you look at a model, because you've locked in your kind of fixed costs like lending, as time goes on, you end up increasing your collections because just general inflation, right? So the amount of money you're bringing in becomes more, but in most cases, in your big fixed costs, like your debt service, that remains fixed. So over time, an asset ends up returning you more cash on cash. So even when we get to this point that we end up having to pay principal, we're still well over that 10%.
Yeah. Yeah. So even after the interest only burns off, she's increased her monthly collection so much that she's still going to be receiving a 10% or more cash on cash return for the year. So Brian asked, what does the property management usually look like for some of your recent purchases for a 50 unit range?
Sure. So that the property management stuff is where it gets tricky, in that this is what we gave up concept. So if you buy, the reason that many people and that gurus teach you to go for 100 plus units is because then the property can afford its own property manager, like someone on site all the time. When you go for something smaller, like a 50 unit, that's not necessarily the case. So what we've done is we found a third-party property manager that my business partner has a decade-long relationship with, because they began in Chicago and then grew their footprint to Indianapolis. They actually have their own assets in that general area. What was super interesting about that is, yes, they have their own assets, but rather than be concerned about like cannibalization of tenants, that they would take the good tenants and give us the lesser good tenants because they own their property. It's a C-ish, C- class property that they have, and we're like a B+. So we felt a level of comfort that it was a different type of tenant. But you know, the crux of it all is we know that they're on site 2 days per week. So we have good property management by people who know that area, but we just don't have, it doesn't make enough money in order to have somebody on site every single day.
Right, right. Yeah. And that is one of the downsides by going with the smaller properties. But like you said, there's less competition going after those properties, so you can at least buy something. Hopefully you can get a couple of those in the same area, and then all of a sudden now you have a dedicated team that's floating between specifically your properties, right?
Yep. And our plan is to expand that footprint so that we're able to do exactly that.
Yeah, cool. Mark G asked, any recommendations or thoughts on using self-directed IRAs?
Oh, great question, Mark. So I'll tell you, for the, I have done this, and I did this for that 130 unit that I went in on. And here's why. Because I knew I wanted to get involved in syndication to understand the flow of information as a passive investor, but I didn't want to touch my liquidity. Like, I wanted my cash in the bank to go towards this active stuff that I'm trying to do. So what I did is I self-directed an IRA from an old job and put that into a syndication. One of the rules of a self-directed IRA is that you cannot put those self-directed IRA dollars into something that you are actively doing yourself. So you kind of have to find someone with a syndication, some other group, to put those dollars into passively if you're going to do self-directed IRA. So if what you want is to have a little exposure to, you know, what folks are doing, what communication looks like, potential upside, or explore a different market and learn as you go, I think that is a super, like a prime way to get in. There's some things you want to know about EBIT. Google this if you're going to get serious about it, or shoot me an email and I'll get you in touch with people. I don't want to go off the rails again, Oliver. But there's stuff to know before you do it. Right.
So do you have a provider for that?
I mean, I've gone through 2 different groups. I've had good experience with both of them. I'm happy to provide names.
Right. And Mandy's email address is the mandy@mandymcallister.com. I'll copy and paste it in the chat right now. Any more questions that anybody else has? I have one more question for you, Mandy.
Okay.
So you told me that deal that someone actually basically ripped you off on, right? Was that the most important lessons you've ever learned in life, or do you have another one?
You know, That was a good one. I'm not going to lie to you. It was an expensive one, but it was a good one. But I think the biggest life aha moment that I've had, and I talked with somebody about this the other day, is, you know, it's like the whole rich dad, poor dad thing. You know, like I did everything exactly the right way. You know, like I was the good kid. I was the athlete who got a scholarship. I had the perfect, you know, career path, whatever. But, you know, for me, the biggest life aha moment is that you get to pick what you do with your life. And if you figure out this money stuff with your seeking forever money cash flows, then you get a true sense of freedom and power to do with your days whatever you want to do with your days. So the biggest life aha lesson is that you get to pick.
Couldn't have said it better myself. That was really cool. I really like that because that's so powerful. For me growing up, like I never even considered not choosing what was like already like laid out. Like even like I always say the story about like my wife. The first date I ever went on with her, she was picking things from the menu and then subbing things in and subbing things out. Like I never did that before. When I went to the restaurant, I'd order number 13 or I'd order number 12. Like I never was like, I want pickles and I want, you know, I don't want that and put this on there and don't take this off, you know? So it's, totally agree with that in life. Like you have the ability to pick and choose what you want in your life, especially when you base it on cash flow and cash flow coming in so that can pay for the rest of your life. And then you can pick and choose the rest of the parts that come in.
It's so like you saw behind the curtain of The Wizard of Oz and you can't unsee it, you know? So it's pretty powerful.
Wow. Totally agree with you. Anything else you want to share with everybody? But I really love that last message. That just totally rocked my heart because I totally resonate with that 100%.
You know, and in regard to that, something that I'd be happy to share with you guys is, you know, this idea of financial freedom and power and you get to pick, you know, what the heck does that mean? I mean, that if you can't make that granular, if you can't make that something you can get laser focused on, then, you know, how do you know where you're going? If you're going to go on a diet, first you get on the scale and you figure out where you want to go and you make a plan, right? So if what you're seeking is this financial freedom stuff, like I made a calculator that helped me really kind of figure out how many doors I need, how much cash flow I need to get where I want to go. And I found it tremendously helpful in terms of informing my focus. I'd be happy to share that.
Cool. How do you want to get that to people?
Well, you could email me. I could try to get the Dropbox link right now as we're chatting. Or you could just shoot me an email and I can email
Mandy. Email Mandy and then
email me.
Yeah, email you. And that's Mandy@MandyMcAllister.com. This is a really good question that came through. Teresa said, how many hours a day do you dedicate to this? And does it interfere with family?
Oh, girlfriend, let me tell you. So another big thing that I do is this Aspiring Women Achieving More. And a lot of it is, you know, because I do a lot of stuff. I do a lot of weird stuff, you guys. So there's, you know, my day job is pretty full. Like it's a demanding job. Like I'm in these procedures with physicians. I'm full-time single mom, full custody, whatever. What has really helped me is time blocking. And I've done a couple videos on this too. So shoot me an email and I'll send you the link to that. But the thing is, I have realized that if I can give full focus to any one thing that I'm doing, I squeeze the juice out of it and then I go on to the next thing. Right now, sure, I'm bribing my 4.5-year-old with a toy and to be on his iPad right now, but I am totally here with you guys and I'm gonna be totally there with him when I'm done. So in my opinion, you know, it's just, if you can show up fully wherever you're at, the guilt of what I should be somewhere else is removed and your impact is way bigger if you can go all in. So I think you might really like that little video that I made recently. So shoot me an email, please.
Good job. That was awesome. That was fire. Yeah, 100. Being present, I mean, can take care of a lot of all the guilt issues, all of the issues of feeling bad. Yes, Teresa's saying, that's great words. I will send an email. Awesome.
Awesome.
All right, Mandy, we really appreciate you. We love you. We got so much value out of you. So many great life lessons. So many fire comments. Oliver and Mandy for your wealth. Oh, thank you. Thank you, Oliver and Mandy, for your wealth. That's yeah, in the chat, let Mandy know, say thank you. Let me know if you enjoyed Mandy's presentation today in the chat. Thank you so much. Guys. Great job, Oliver. Yes, Barry says. Jacob says, thank you, Mandy. Brian says, thank you, Mandy. Appreciate the presentation. Matt Collins says, thanks for the wisdom. Harold says, thanks, both are excellent. Awesome, Mandy. I really appreciate you. We're going to be doing a lot of things together because I just love your energy. I love what you're looking to do in life, and just pushing for more and pushing to help people have a bigger impact. And it's amazing. I really appreciate you and appreciate your concepts.
Yeah, Oliver, thank you. We absolutely will be working together.
Cool. Thank you, Mandy.
Awesome.
Thank you, everyone.
Thanks, guys.
Hey there, I hope you enjoyed the video. If you did, please click subscribe down below and give me a thumbs up. You can reach out to me on Instagram or Facebook at Oliver Fernandez 3. I have new videos just like this one dropping every week. So drop a comment down below and let me know what you want to hear next. Until then, keep growing and keep learning. Just do it.